Hello everyone, this is Mark with Semantics Research with your daily report. So today we had a gap up in the market with the S&P rallying in the early IB session and then chopping around at the highs towards the middle to the end of the session. It appears that there was a rotation from quality to growth and risk, but I doubt this rotation will last very long. We are still likely in a bear market, and this is simply a rally before longer time frame sellers step in. And I do think eventually this bear market will subside, but I do not think we're quite there yet. Perhaps it is a few hundred handles lower, or perhaps even more, but all I know is it's likely to happen ahead of the data, as it usually leads ahead of it. If we look at history, the market tends to move ahead of the economic data before we see a turnaround in the economy. Now, if we take a look at oil, we did bid higher today as we recover some of the losses from last week. The refining margin has surged to $60 a barrel, which is close to all-time highs, as U.S. refiners are at max capacity at the current moment. There is little signs of slowdown in demand in the U.S., which is the largest consumer in the world, and we are in the middle of peak driving season, so demand will be especially high during this time of year. When it comes to green energy, there are poor policies and plans for the transition to green energy, which will take many decades to get there. These alternative sources they only make up 3% of the contributions to power, and to turn off oil and gas for energy will put us in a very bad spot. We have a duration mismatch, and these tend to be 30-year cycles, and we cannot just simply shut off pipelines and switch to green energy. The Fed cannot simply fix the issues with their policy, as there is a major supply problem as well, and we must convince companies to invest more capex into production and avoid more energy policies that will hurt this, like windfall profit taxing for making too much quote-unquote profit. But yeah, I mean, we see a lot of panic with the current administration, with them asking the Saudis to pump more oil and remove restrictions on Venezuela. But, we are also banning the Keystone Pipeline, which is kind of a mixed bag of things, I mean, after all, we are the largest energy producers in the world, and the U.S. is in a great strategic position to pump more oil, but whether or not this gets done, it is rather questionable. We must understand that demand is quite inelastic for hydrocarbons, and the demand is growing every day, as there's not enough minerals to extract to invest in alternative energy to meet our energy demands. And oil has a very low elasticity of demand, so that means that the demand for oil does not change significantly when the price for it changes, given how dependent the global economy is on it. The supply of oil is also fairly inelastic, given how complex and costly the process is to initially set up the oil extraction. And in order to fix this issue with higher prices in oil, we must fix the supply side. Because if we do not see a solution for the Russia-Ukraine war, we will likely see this problem last for many years. Also, we must understand with these energy companies, they would rather do stock buybacks versus reinvesting in their production due to green energy policies. So in the time being, we have a very limited supply versus the demand, and there's a pent-up demand in the economy being unleashed. And what needs to be done is to increase storage infrastructure in the world and pipeline capacity. And the amount of gas that Europe buys from Russia is the amount of gas China and Japan buy every year. So it is likely we will see high volatility in energy prices for the time being due to more inflation, more basis risks, and the basis risk is risk to the term structure in the commodity markets, which is different from different prices in different regions. Also, another thing that could affect the price of natural gas, for example, is weather, as a very warm winter could drop prices, or a very cold winter raises demand and causes prices to rally. And another factor in this is that also China, which can also raise demand for natural gas and oil if they're depending on if their lockdowns are lifted or if they persist, then you will likely see demand be affected, of course. And even if we have a recession globally, I highly doubt that there will be a fix for this oil issue, as there's no substitution for the limited supply in energy at the current moment. Now, if we take a look at the existing home sales for May, we've contracted to negative 3.4%, which is slightly better than analyst estimates. We are down to 5.41 million from a previous 5.6 million. And the month-over-month sales have dropped in 3 out of 4 regions in the US, and yearly sales have fell in all 4 regions. It is expected that we will continue to see this decline as housing affordability is further worsened by higher mortgage rates after the rates have doubled after the mortgage-backed security markets have seized a few weeks ago. And also you have to remember that this data that was released today is also lagging, so we do not know the housing data for this month as the rates have doubled. We must understand that the housing also makes up a majority of the consumer's assets rather than the stock market. So if we see a contraction in housing prices, we could continually see potential shock in the economy due to further risks. According to Redfin, a buyer who is on a $2,500 monthly budget can only afford a $400K house at 6% mortgage rate versus, let's just say 6 months ago, when the mortgage rate was about 3%, they could afford a $517,000 house. This highlights the loss of buying power at an average of $118,000. These higher rates tend to have a cooling effect over time on a red hot market. As we had a really strong housing market for the last 2 years, and we are seeing a slowdown of competition at the current moment, but it also puts buyers in a very tough spot. Last week, we've seen the mortgage rates rise from 5.23% to 5.78%, which is actually one of the largest one-week jumps since 1987. Now, going to the GDP, the Atlanta Fed GDP now is set to release tomorrow morning, and it is probable that the market has priced in a very bad number. So if we get perhaps a very slightly negative number, it could cause the market to rally a bit. And last week, we see the GDP now estimate was lowered to 0% from 0.9% previously. We must note that the Fed has started their fight with inflation a bit too late. And if the Fed was to do the worst case scenario by flip-flopping and easing their foot off the brakes because of the growth consequences, they will likely prolong inflation. And if they try to pause and cut, they would have to keep starting again and again until the matter is finally solved. Right now, the only argument that the Fed has for a good economy is the labor market being very strong, which is due to filling vacancies from the pandemic. Growth is currently slowing down, and many analysts expect Q2 GDP to be negative. So if they were to go through with killing demand, it will do a lot of damage to the economy, and we have started raising rates and tightening way too late, which in my opinion should have been done last year. And the week in March where the CPI was 7%, we must remember that we were still injecting liquidity, so that it just makes no sense, really. I do feel like that we will have an ugly number in the GDP next month. We do see that the PPI was pretty bad, and that tends to lead to CPI, and there's not really any signs of slowing inflation just yet. I do think that the real rates are very important to watch, as with the real rates being low during the pandemic, we saw growth in tech outperform due to lower borrowing costs, but the real rates being positive, it has a very great impact on growth stocks. And I like to look at what part of the cycle we are in for the correlation in sectors like tech and discretionary, which does well in expansion versus consumer staples and utilities, which outperforms in a slowdown. Now, if we take a look at the U.S. junk-rated corporate bonds, the spreads have hit above 500 basis points. The U.S. junk-rated corporate bonds usually gauges the risk of defaults, as it signals higher probability the higher the yield goes. The yield is how much the investors demand to hold the debt, and the higher the premium, of course, is the more it costs to borrow for the bond issuers. And you can imagine that the companies with poorer cash flow and high debt have the highest risk. And due to the Fed signaling that they will be aggressive with tightening, and since we are pricing in tightening of the global economy, we are seeing credit risk pricing in higher risk, and there, as the higher the rates go, there's a higher chance of all these zombie companies in S&P may default. If we remember last week also, the Swiss National Bank tightened 50 basis points, which tells us a lot of context as well, and this tightening will tend to feed upon itself, and which signals that the Swiss National Bank is trying to avoid imported inflation and protect the currency. The problem is that we have so many people hoping that inflation was transitory, and now people are realizing that inflation is here to stay, and likely this will hurt the lower income class especially, and a lot of consumers that are used to spending tons of money will now be in for a rude awakening, and they will need to change their spending habits, or they'll be drowning in their own debt. So yeah, as longer the inflation stays high, the more demand destruction we will see in various sectors, and over time, people will worry about their income and stop spending on discretionary goods, and companies will suffer, and those companies will then in turn lay off workers. So that could be a very ugly spiral. Now, with globalization we've had for many decades, we have seen access to bigger markets and deflationary effects that resulted from outsourcing and greater efficiencies and rapid tech advancements. But lately, it's been quite hard to engage with trading partners like China, Russia, and Iran. And the argument right now is that globalization can lead you down to a path that is a threat to national security. Like, for example, China making 99% of biopharmaceutical drugs, or Taiwan making 40% of the chips in the world, is a potential risk. It is possible that we may start seeing a shift back to manufacturing, back to the United States or other friendly countries. And we are seeing some of that happen, like some aggressively building wafer fabs in Arizona. Mind you that it does take about $18 billion to build these wafer fabs, and about 3 to 5 years to finish building it. And we do see Samsung also building another one in Texas, but it hasn't started yet. But the issue is that as we deglobalize, it takes a long time. And we are about 3 to 5 years away from being self-sufficient on the supply side. So we see a bunch of Fortune 500 companies are starting to do this in some way, but this will take many years as we are still highly reliant on other nations. And we are seeing the effects of this as the U.S. and China relations have been seeing friction every day, and China does have leverage on us, but that is going every day as the time passes, as we further decouple from China. We also have to note that China also owns Smithfield's Foods, which is one of the largest producers of pork and chicken in America, and they have announced that they are shutting down the Western division because the food prices are too high, which tends to make me think that this is a geopolitical decision. So it is very key for the Department of Defense and the U.S. government to take control of the situation. And we see this argument going back and forth, like one topic being that whether or not we should lift the China tariffs, but that is more of a short-term solution for a longer-term problem. So we must weigh out the risks and take action accordingly. With that being said, there is also a great awakening of sorts for the global economy as the central banks seek to battle with more aggressive policies. We do see the Swiss National Bank, like I mentioned before, raising 50 basis points and getting ahead of the ECB, which is signaling a decoupling of sorts. Because typically you do see the Swiss National Bank try to battle a strong currency to fight speculators and go generally in line with the ECB. But seeing what's happening currently with Japan, which is potentially the next crisis that nobody is talking about, and the UK, the Swiss do not want to go on the same path of currency depreciation. That would make the inflation problem much more difficult. There are many difficult headwinds ahead for policymakers due to the late response, and it is likely that this era of massive liquidity injections and low rates is likely over, and we will witness a tightening of financial conditions that feed on itself. And as a result, we will probably see collateral damage and unintended consequences that will further worsen financial stability and threaten livelihoods. And we will also see higher competition in the markets as the risk-free rate goes higher. So, yeah. And with that being said, I want to thank you all for watching. This is the end of the video. Be sure to subscribe and give us a like if you enjoyed the video. And be sure to check out the links in the description for more updates.